Welcome to the Qualified Opportunity Zone Fund mini lesson as we walk through our real estate transaction planning portion of Teaching Tax Flow REI. We have a lot of content in this mini lesson, so I'm going to walk through it rather briskly. I expect that you might want to pause this mini lesson and check some reference materials out because the Qualified Opportunity Zone Fund is a relatively new concept, new strategy, with a lot of different rules and regulations. So let's jump right in. We're going to first define what an Opportunity Zone Fund is. This is a strategy that was born with the Tax Cuts and Jobs Act of 2017. We always talk about tax law. One of the laws of Teaching Tax Flow is tax agencies are our involuntary business partner. So to encourage the reinvestment of capital gains into domestic projects, the Opportunity Zone Fund strategy was born under Tax Cuts and Jobs Act. We're going to look at the mechanics and the tax benefits of it. We're going to actually let you know what the certification requirements are for a Qualified Opportunity Zone Fund. An Opportunity Zone is a geographic area. An Opportunity Zone Fund is a special type of investment vehicle that meets certain qualifications. There's a big difference. We're going to loop back in our awesome real estate transaction planning chart, and we're going to look at some different comparisons as far as potential properties and what would fit best for the Opportunity Zone Fund investment. So let's dive in. Opportunity zones. Again, this is right from the IRS website. I'm not going to read this whole thing, but the Opportunity Zones are economic development tool that allows people to invest in distressed areas in the United States. Remember, tax agencies are our involuntary business partner, and I said this was created under the Tax Cuts and Jobs Act of 2017. If you check this link out right here, this will actually take you to an interactive map that identifies where opportunity zones are in the United States. Each state governor was tasked back in 2017 and 18 to identify areas within his or her state that are opportunity zones. So that's the first part, is understand that there's an opportunity zone, which is a geographic area. Now, Opportunity Zone Funds are separate than those Opportunity Zone geographic areas. So, per the IRS, taxpayers who invest in Qualified Opportunity Zone property, here's the key: through an Qualified Opportunity Fund, can temporarily defer tax on eligible capital gains. So, big things to remember. You have to have a Qualified Opportunity Zone Fund that owns property in or business in qualified opportunity areas. You have any type of capital gain is eligible. So we really think about real estate when we think about capital gain, but capital gain from stocks, from selling your business, are all eligible to be reinvested in a Qualified Opportunity Zone Fund and get these tax benefits. Here are the benefits. You could defer the tax on the reinvested amount until December 31st, 2026. These are the type of gains, both 1231 gains and capital gains. And obviously we can't work with a related person. You don't have to pay tax on that until January 1st, 2027. That's when it becomes taxable. Okay. So this is important. Any type of capital gain, could be real estate, could be otherwise. Using the proper fund, we're going to talk about that in a moment, defer the gain until 2027. So this is tax deferral. This makes sense when you're that red diagnosis. This hits on purple diagnosis, tax deferral. It also hits on gold diagnosis. There's a step up in cost basis that we're going to touch on in a second. Here we go, the tax benefit. So you're automatically going to get that temporary tax deferral here. And then if you hold, I'd mentioned that gold tax strategy, adjustment to basis after 10 years. So if you hold the asset for 10 years, you get a step up in cost basis. So these are the tax benefits we're looking at right now. And again, you might want to pause this mini lesson to really read through them, but understand that cash flow versus tax flow, and this law was written to encourage that reinvestment behavior. Now, we want to talk about certification requirements because I know I'm repeating myself, but just buying a property that's in an identified opportunity zone does not give you the tax deferral and does not mean that you have a qualified opportunity zone fund. The requirements that you're looking at right now, that's what's the certification requirements are to make sure that if you have an opportunity zone fund, that you are meeting the requirements to provide the investors with the tax benefits from the previous slide. Now, qualified opportunity zone funds, I want to point out right here, filed this form 8996, and that's how they make sure that they continue to certify. I would say the vast majority of taxpayers do not create their own opportunity zone fund. They invest it in someone else's fund or syndicator's fund, and that way they don't have to worry about all that recertification responsibility. Let's look at that real estate transaction planning chart. We use this in many of our mini lessons. We're talking right here about an investment. Could be, in this case, an investment property, but remember, it could be any capital gain. If you sell that and you reinvest just the gain, this is the difference between the QOZ and the 1031 exchange. With the QOZ, you just have to reinvest the capital gain portion. You don't have to reinvest the entire amount like on a 1031 exchange. You will not pay tax currently, and you'll get that tax deferral. Let's look at this property comparison worksheet. We use this worksheet in several of our mini lessons, and what we're looking at is cash flow versus tax flow. And so we're property A here, which you would have a lot of equity in. This is just a portfolio, a sample portfolio of someone that has 3 rental properties. Property A is the one that has the most amount of equity. There's no mortgage in it on the property. Out of these three properties, property A, in Teaching Tax Flow's opinion, would be the best candidate for a qualified opportunity zone fund. You might say, why? Remember, tax flow versus cash flow. This taxpayer would net $237,000 based on our assumptions, which are right here, at closing. Well, the taxable gain is less than, the taxable gain is only $90,000. So this taxpayer would only have to invest the $90,550 into a qualified opportunity zone fund to defer and not pay any current tax. Where the 1031 exchange, they would have to reinvest $255,000 minus closing costs. So the point of this is, I'd say property A is the best candidate for that qualified opportunity zone fund investment. Red diagnosis, purple diagnosis, gold diagnosis. Wrapping it up. A lot of content here, I know. Review your tax return, property portfolio, and look at your teaching tax flow diagnosis. Determine if you have a property or a capital gain. Again, it could be a stock that's a good fit for that qualified opportunity zone fund investment. So if you have an asset that you have a large capital gain that you want to sell, but you don't want to have to pay the tax on that immediately, and you don't want to do the 1031 exchange, or it's not real estate related, this might be a great option. Make sure you use our IQ test. Identify strategy, quantify result using our, with this qualified opportunity zone fund investment. Don't let the tax tail wag the dog. So if you have a capital gain and you like the strategy, run the numbers, just like with our property example. It really makes sense with property 1. And then if you do the qualified opportunity zone fund reinvestment, make sure you report that on your personal return. You're going to report that when you sell the property. And in addition, you're going to report that on a form 8997, and you're going to file an 8997 each year to continue to report that tax deferral. All right, I know a lot of content in this mini lesson, but this is a very important strategy in our transaction planning. Thanks for watching. Have a great day.
John here from Teaching Tax Flow. I wanted to thank you for watching this video. We literally have hundreds of hours of content between podcasts, webinars, videos just like this built specifically for you, the taxpayer. Whether you're a full-time employee, you're a freelancer, you're a contractor in some other sense, or you're thinking about getting into business for yourself, everything here at Teaching Tax Flow is perfect for you, basically going off of the roadmap provided by the IRS to legally and ethically reduce the taxes paid over your lifetime. So be sure to subscribe to this channel and connect with Teaching Tax Flow, and we will see everybody very soon.